Assalamualaikum, my name is Amirul Haziq and I represented my group to start the presentation about Enron scandal. This is our group members. This is a list of content that we will explain later. Let's start with the company background. According to what we see in this slide, I will explain briefly about this company. Enron Corporation is an American energy, commodities, and service company in Houston, Texas. This company was one of the largest in United States. Before bankruptcy, Enron had around 20,000 employees in various industries, including electricity, natural gas, and others. In highlight what I show in the slide, it was America's most innovative company. This title was get in 6 consecutive years. This company came bankrupt because bad management, accounting fraud, and weak internal control. Next is the governance structure. This structure is the most effective in Enron scandal case. Let's see what the real rule of governance structure. First, we have a board of directors. The rules of board of directors is oversight of management and corporate strategy. But in this case, the board of directors allow weak internal control and aggressive accounting policy. Next is executive management. As we can see, this is their manager that manipulate results like culture focus in short profit and stock price. Third is audit committee. Audit committee is ensure final statement accuracy, but this company did not independent and auditability of audit. And next is internal control. Internal control in this company was weak and easily overridden by executive and effect risk of management system. And lastly, internal auditor. Internal auditor is to provide consulting service, but auditor fail to act independence and destroy audit evidence and document. That's all for me.
Assalamualaikum, my name is Dinahan and my number matric is 068023F1129. Now I want to present about corporate governance and CSR. First is a lack of transparency. Enron was not transparent in their financial reporting. They hid debt and loss to make the company look successful. This broke the ethic of integrity and objectivity, because information must be harnessed and clearly. Second is a conflict of interest. Some Enron executives made a personal profit from company deals. This is a clear conflict of interest and goes against the ethic of integrity and professional behavior. After that, loss of public trust. When the scandal happened, people lost trust in Enron CSR effort. It proved that without strong ethics, CSR become meaningless and only for image. For the lastly is a gap between CSR claim and real action. They talk a lot about being ethical and sustainable, but their internal action were the opposite. This show that integrity and transparency were missing in their CSR practice. That's all from me.
I am Nurin Amir Humairah and my matrix number is F111. 3A. I'll be talking about role of auditor. The first one is auditing Enron's financial statement. Arthur Anderson was responsible for checking Enron's financial statement but failed to report the false accounting practice used to hide them. The second one is maintaining independence and objectivity. The firm lost its independence because it provided both audit and consulting services to Enron, creating a conflict of interest. Number 3 is ensuring compliance with accounting standard. Anderson approved Enron's financial report even though they didn't follow proper accounting standard. Number 4 is reporting fraud or irregularities. Although Anderson knew about Enron's manipulation, they failed to report or act on the unethical accounting practice. And the last one is maintaining audit documentation. Instead of keeping audit evidence, Anderson destroyed Enron-related documents showing unethical and unprofessional behavior.
Hello everyone, I'm Kartika Subramaniam and my matrix number is 06D8023F1120. For my part, I will be presented on issues and implications of Enron scandal. Let's begin by looking at the key issues that led to the Enron scandal. Firstly, accounting manipulation, fraudulent reporting. Enron used complex accounting methods such as mark-to-market accounting and special purpose entities to hide its debts and inflate profits, misleading investors and stakeholders. Next, lack of ethical leadership. The top management including CEO Jeffrey Skilling and CFO Andrea Festo prioritized personal gain over integrity and transparency. They encouraged employees to manipulate figures to show continuous growth. Apart from that, conflict of interest, auditor involvement. Arthur Anderson, Enron's external auditor, failed to maintain independence. The firm earned large consulting fees from Enron while also auditing its financial statements, compromising its objectivity. Then, weak corporate governance. Enron's board of directors did not effectively oversee management decisions or question complex financial structures, allowing unethical practices to continue unchecked. Lastly, misleading investors and employees. Enron's executives assured investors that the company was performing well while internally knowing about the massive losses. Many employees lost their jobs and retirement savings when the company collapsed. Now that we understand the issues that caused Enron's downfall, and let's look at the implications. Firstly, collapse of Enron Corporation. Enron filed for bankruptcy in 2001, one of the largest in US history at that time, which led to huge financial losses for investors, employees and creditors. Then, loss of public trust in corporate reporting. The scandal severely damaged confidence in corporate financial statements and auditing practices worldwide. Next, dissolution of Arthur Anderson. The auditing firm was found guilty of obstructing justice for shredding Enron-related documents, which led to its downfall and the loss of thousands of jobs. Apart from that, introduction of stricter regulations. The US government passed the Sarbanes-Oxley Act SOX 2002, which strengthened corporate governance, auditor independence, and internal control systems to prevent future scandals. Lastly, reinforcement of ethical standards. The case emphasized the importance of ethical behavior, transparency, and accountability among accountants, auditors, and corporate leaders. That's all from me. Thank you.
I have found 6 key points of recommendation based on the lesson learned from the Enron scandal. The first one is train and auditor independence. Auditors should avoid offering both audit and consulting services to the same client to prevent conflict of interest. Number 2 is improve corporate governance. Companies need independent boards and audit commit to monitor management and ensure transparency. The third one is enhance accounting transparency. All financial transactions, including hidden debt, must be fully disclosed to show the company's true financial position. Number 4, enforce ethical standard. Auditor and management must follow strict ethical rules and maintain integrity in financial reporting. And the last one is implementing. The second last is implement stricter regulation. Laws like Sarbanes-Oxley Act should be applied to increase accountability and strengthen internal control. And the last one is regular monitoring and quality review. Audit firms should be reviewed regularly to ensure their work meets professional and ethical standards.
First, I want to present a broad reflection on the Enron scandal. The Enron scandal taught an important lesson about the danger of greed and unethical behavior in business. Enron's executive manipulated financial reports to hide losses and mislead investors, while its auditor failed to act with integrity. The company's collapse show how a lack of honesty and transparency can destroy trust, jobs, and reputations. This case reminds us that strong ethics, accountability, and transparency are essential for good corporate governance and long-term success. I want to discuss about real evidence from the Enron scandal case. First, real evidence is financial statement manipulation. Enron used special purpose entity SPES such as LJM1, LJM2, and CHUCO to hide billions in debit and make its balance sheet appear stronger than it was. Second is false accounting practice. Enron used mark-to-market accounting, which let them record potential future profit as current income, even if profits never actually exist. Third one is shared audit document. The auditing firm Arthur Anderson was found to have destroyed audit paper and emails related to Enron accounts once investigation began. And final one is executive involvement. Jeffrey Skilling, the CEO of Enron scandal, and Kenty Lay, the chairman of Enron scandal, were proven to have approved misleading reports and pressure employees to manipulate data.